Hello, everyone, and welcome to the Weekly Watch. I'm your host, John Briggs. Thanks to Brian Dangerfield for covering for me last week during my holiday. I actually want to return to something he and I talked about a couple weeks ago, which is how the only path, or I would say perhaps the most likely path to a soft landing globally, appears through that of lower energy prices. And I bring this up because we've seen some significant declines in oil and energy prices this past week, or at least as of this recording. To remind listeners, the issue with oil continues to be on the supply side of things, which is stuck. So any change in the price of oil really has to come from the demand side. And the recent declines we have seen have been spurred by expectations of demand destruction and recession fears. Now, how to quantify that is going to be difficult. But even given demand destruction, we think it'll be hard to see oil back to $70 or less, given the supply situation. But any declines from over $100 would be helpful, $100 a barrel, I should say, will be helpful for a number of reasons. First, the Bank of England and ECB target headline inflation. So any declines in energy helps European and UK inflation a lot. There's some impact in the US, but US inflation is less externally influenced by energy prices than others. And lower oil certainly helps ease the cost shock that we're seeing everywhere. But again, the impact is larger in Europe, given obvious war issues, and the UK versus the US, which produces a lot of energy on its own. So the result is lower oil should have a larger influence in pricing out central bank hikes in the UK and Europe, arguably, which is actually something that has happened this week, at least so far until the political environment changed things in the UK, which I'll get to in a second. Again, this is more of a path to a soft landing, a lower inflationary impact, which central banks are trying to chase with rate hikes, and a softening of the cost shock that should alleviate fears of recession, or at least lessen perhaps how deep the slowdown could be. So we haven't seen enough of a decline in energy prices, I think, to make this argument in full yet, but that's the lens through which we're looking at declines in energy. Expected demand destruction, which leads to lower energy, could actually help buffer from some of that potential demand destruction down the road and take central banks' foot off the brakes, at least to some degree. So shifting gears completely, I'm now going to turn to politics and the recent resignations in the UK. I have Ross Walker here, NatWest's global head of economics, global and chief UK economist, and he's hopefully going to help shine some light on these developments because I know better than to comment too much on UK political developments. So Ross, starting with the pure politics, for those outside the UK, just a quick recap of the events that led to Johnson's resignation.
Yeah, so the Prime Minister announced his resignation. He's been under some pressure in recent months. To some extent, it's the scandals themselves that have caused this pressure, but I think more it's really been his response, some of the obfuscation, perhaps, maybe in some of his approach to dealing with this not being sort of fully transparent and accurate with his answers, shall we say. So there's been sort of mounting pressure, and it's really one that has centered on his integrity and the way he's dealt with some of these problems. But as you say, the net effect is that he has now resigned, and so we move to the next stage of the process.
Okay, so he's out, or he's not out, but he's resigned. When will a new PM be in place, and should we expect any fiscal monetary policy changes as a result of these political changes?
So a lot will depend on how many put their names forward, and ultimately, if, as happened with Theresa May, if there's just one candidate left standing, then this process could be over really by late July. However, if we have a two-horse race, two candidates are whittled down by MPs, then the vote goes to the wider Conservative Party membership, and that will take some time to organise. So it could be late summer, early autumn before a new Prime Minister is in place. But either way, at the latest, probably by mid to late September, but possibly as soon as by the end of July.
Any views on who the next PM could be? I know it's early.
Well, anyone who follows British horse racing will know the Grand National, where you have a very large field, a huge number of potential winners, and it feels like that. There are probably half a dozen candidates, I would say, with a realistic chance. I think the big problem politically is that it's going to be hard to find a candidate that can really unify the Conservative Party, and by extension, forge a agreement, a high degree of consensus around a future fiscal policy agenda. And it's and the bottom line, I think, is that as we approach the next election, and the risks are that comes sooner, possibly as soon as spring 2023. What comes with that is the risk of further fiscal slippage and therefore pressure on the Bank of England, given the inflationary backdrop, essentially to counter any of that fiscal stimulus that is deemed excessive.
Okay, so what are the market implications here? What are the implications for our central bank call, for the Bank of England, sterling, gilts? What are the thoughts here? We're seeing some initial rally in sterling, for example. Do we think that that's going to continue to be supported for the currency, or what are your any changes on the Bank of England?
Yeah, I think the sort of immediate reaction we saw today in markets, a bounce in sterling, marginally higher, longer term yields, that feels right. For the Bank of England, I think probably for the remainder of this year, not much changes. The chief economist at the BOE, Hugh Pill, this week provided a sort of more detailed dissection of the bank's latest guidance, and essentially that's saying they're still quite cautious in the near term. Therefore, I think we probably see a continuation of quarter point rate rises, beginning with the next meeting in August. We're bringing forward our forecast for subsequent rate rises. So whereas we thought there might be a delay until early 2023, I think more likely we get another quarter point hike, say in November, the forecast round month, and probably another quarter point hike in the early part of 2023. The big risk, I think, that relates to the likelihood of looser fiscal policy with an eye on an earlier election is that you're going to put greater pressure on longer dated yields and quite possibly forcing the Bank of England into a more radical monetary policy tightening in the early part of next year. And that was the other aspect of the BOE's revised policy guidance. Near-term caution, but if inflation pressures prove more persistent, if we see more wage pressures coming through, that could force their hand to not only continue raising rates, but quite conceivably increase the size of those bank rate rises to moving in 50 basis point clips. So probably more medium-term uncertainty first half of 2023 around both the fiscal and monetary policy outlook in the UK.
Yeah, medium-term uncertainty and probably slightly upside risk. All right, well, thanks, Ross. That's it, everyone, for this week. Next week, we're watching US CPI, which we still see as fairly strong, European inflation data, UK GDP, and of course, any new developments along the UK political lens. Thank you for joining us for this episode of the Weekly Watch. As always, please remember to hit subscribe so you can watch our latest episodes as soon as they're available, and hit the like button so it's easier for others to find it. Thank you very much and have a great week.